All right. So, all right, Mark, let's start. All right, folks. Hello, everybody. Welcome to Fibonacci Mondays. We start off the week with Fibonacci ratios, harmonic patterns. I'm going to go over a couple of live situations today just to demonstrate the effect of Fibonacci's harmonics. Levels of support and resistance. We have very interesting situations where the fundamentals have created some situations. So do you really look at the fundamentals while trading? What do you do when the fundamentals are affecting the market so much? As a trader, what do you do? Bottom line is we come down to the Fibonacci's, and as traders, what we want to do, we want to pull out profits from the markets, regardless of what has created the price movement, whether it's fundamentals, whether it's technicals. That should be the least of our concern. Now, again, it does not undermine the importance of fundamentals or technicals for that matter, but as I always put it, as traders, you are looking for opportunities, the best probability opportunities to get into a trade. So you have to do your homework, do your technicals, let price go wherever it wants to go. Do not try and predict price, follow price, and take your trades within that. Right, just as an introduction for the folks who are new over here, my name is Sunil. I have my own website. This is my website, fibforex123.com, where I conduct special services for mentorship. We have live trading rooms. We have a set of subscribers. On my website, at the end of the page, you will come across the PDF downloads, the free PDFs, which the Fibonacci's, I use Fibonacci's mainly, only Fibonacci's, to analyze my trades. And for those of you who are not familiar, you can download these Fibonacci PDFs, which will give you a very brief idea, a decent idea of what exactly are Fib ratios, how they must be used. Every Fibonacci ratio has got a different situation. We look at Fib retracements, Fib projections, Fib expansions, Fib fans. There are situations where you must use the Fibonacci's in their own effectiveness, I would say. Just like the tools in a carpenter's toolbox, you would not probably use a screwdriver where a hammer can do the job. Similarly, you would not probably want to use a Fibonacci retracement where Fibonacci fans can do the job. Now, this difference becomes important because knowing Fibonacci's by itself is definitely important, but where to apply it and how to apply it correctly becomes much more important. I assume that everybody is familiar with Fibs because we've been conducting these sessions on every Monday for quite some time, and I'm going to go over the harmonic patterns. Let me briefly go over the PDF of the harmonic pattern, and we will come down to a live market situation where we will analyze the trades based on these concepts. My point has always been that only if and only a technique, a system, a strategy is effective, then you would spend your time on it. If it's not going to be effective, then you're not going to waste your time looking at something. We have found this effective. I have personally used it. Fibonacci's harmonic patterns, very, very effective. Very briefly, let's go over what harmonic patterns are so we can come down to the live trade situations and have a look. Harmonic patterns apply specific Fibonacci retracements and extensions to a price structure. Now, these are patterns. Harmonic patterns are very, very powerful and give you very straightforward entry and exit. The main advantage is that they leave very little to guesswork. Your Fibonacci ratios, your levels are absolutely fixed. So it sort of keeps out the emotions out of a trade. You really don't have to second guess it. If this condition is satisfied, condition 1, 2, 3 satisfied, you have a setup, period. First thing we will be looking at, we start off with the Gartley pattern. I would not want to waste too much time going into the details of a Gartley. Nevertheless, to say what exactly is a Fibonacci ratio, what exactly is a harmonic pattern, and why does it work. Now, the Gartley is one of the most commonly occurring harmonic pattern. That is the reason why we look at Gartleys. But more than anything else, let's not waste time on this. What I want to go over is what is a harmonic pattern and why does it work. right? Look at it this way. My point has always been, when you are trading any currency, a equity, a commodity, a share, a stock, you are actually buying and selling something, but are you actually trading that particular financial instrument? No, you are trading other traders. Trading is a zero-sum game. When you are buying, somebody is selling. When somebody is selling or somebody is buying, sorry, that means you would be selling. It often becomes a zero-sum game. So understanding the psychology behind price movement, what the other traders are thinking about price movement, becomes prime importance. And for these matters, levels of support and resistance count. Fibonacci ratios, retracements, projections count, because price respects these levels. Coming down to a harmonic pattern. Now this is a Gartley pattern. Just let's not talk about a Gartley. Let's talk about a harmonic pattern as a whole. Basic point is, what is a harmonic pattern? In brief, a harmonic pattern is one impulsive move followed by two corrective moves. If you look at a structure of a harmonic pattern, this is what it is. This is psychology. What you must try and understand is, why does a harmonic pattern form? It's like, why do divergences form? Why do Elliott waves form? Elliott waves are effective. But why do they form? Well, it is the human psychology. It is your fear, greed, your emotions of all the traders put together, which create chart patterns, which make chart patterns very, very effective. I have gone over this previously, and let me go over it very, very briefly again. A harmonic pattern is a pattern for those traders who get caught out in the first retracement. All right, because it gives you two corrective moves. Now look at the psychology behind this. You have price giving you an impulsive move. A lot of traders get into it thinking the price is on an uptrend. Price gives you a pullback. This pullback does not take out the previous low, and it starts rallying from here. Obviously, this becomes, in technical language, this is also known as a 1-2-3 pattern. I would call this a 1-2-3 pattern. So as a novice trader, as a new trader who's not very familiar with harmonic patterns, I would say this is technically a very nice 1-2-3 pattern, and price is expected to go long. So I would rather go long. What is your criteria for getting into a 1-2-3 pattern? Simply put, if price breaks the high of 2, you must enter long, which is logical. If price breaks a previous high, it gathers a lot of momentum, price would rally. But what if price does not break the previous high? Now there comes the catch. Professionals know exactly what happens on this 1-2-3 patterns. I, as a new trader, enter it. I would keep my stops beneath my 0.3 somewhere. As an aggressive trader, I would go long from here. The price is generally driven down once more, only to take out the stops of me. Now, me and the other novice traders along with me constitute 85% of the market. Isn't it a fact that in Forex, 85% of the traders lose? It is only the 15% who win, who take the money from the 85%. Again, reasoning, why do chart patterns work? This is one thing which you must realize, you must understand. Why does an Elliott wave form? Why does a Wolfe wave form? Why does a harmonic pattern form? Why do 1-2-3s form? Chart patterns are very important. My policy has always been, and you'll know it, I don't look at indicators. Indicators are lagging. There are a lot of traders who will look at the MACD single crossover, who will look at a stochastic overbought and sell from there. Indicators are lagging. Look at chart patterns. Try and understand the movement behind why a chart pattern works, or why does it form. So in this case, very simply put, you have one impulsive wave which is followed by a corrective wave. As a new trader, I would try to go long. The professionals will drive the price down once more to take out the stops. Now, there is definitely a possibility that after this, price may reverse down. So you might say, how do you know that? Well, the speciality or the characteristic of a pattern says that the entire pattern must be played out within the boundaries of the initial impulsive wave. So if initially price does not break the high, you can expect price will make one fresh low which will not take out the previous low. If you come across a situation like this, you have a very high probability of price rallying up. Now this, in a sense, is what a harmonic pattern is. You have specific Fib ratios being followed. Now, why does price follow specific ratios? Well, I will not be able to in a position to explain to you, but nevertheless, I want to go over the bat pattern because that is the pattern that we are looking at right now on a live situation. A Gartley and a bat, there's not too much of a difference, but very briefly, again, in a bat pattern, a bullish bat pattern, you have an impulsive move, which is followed by one corrective move and a second corrective move. Impulsive wave followed by two corrective waves. In a bat pattern, your first corrective wave stops roughly at 50% of your initial impulsive wave. As it says over here, 38 to 50%. Your first corrective wave will end over here. If it does, you can expect your second corrective wave to form at 88.6% of your impulsive wave. Now, this may sound confusing initially, but once you get used to it, it's really, really very simple. Impulsive wave, first retracement at 50%, second retracement at 88.6%. It does not take out, it plays within the boundaries of the impulsive wave. Now your D becomes a reversal level for the simple reason that it is forming at 88.6 of your impulsive wave plus Fibonacci's. If you take this BC and project it down, it will form at a Fib ratio, either 1.618, 2 or 2.618. It may be any ratio, but it has to be at a ratio. If it does, then you have your D forming at a reversal level, at a strong support level, which is a confluence of two major supports. And you would expect price to rally from here, giving a true trend. Right? So you are looking at one impulsive wave, which is followed by two corrective waves, which gives you the larger term trend in its place. All right. Just one moment. Right? Okay. Everything fine? It's a recording, so I'm just, I think everything, more voice okay, everything okay. Just one small brief check. Right? Oh, questions we will take after the session is finished. Let us finish up with this and we will take questions in that. Maud, can you confirm please? Voice is okay? Okay, thank you, Jay. Let's get down to our charts. Right? I want to have a look at the British pound, sterling pound on a monthly time basis. Now, we will be looking at Fibonacci ratios. We will be looking at levels of support and resistance, measured moves. Again, coming down to my point, look at price. Price will always give you clues. Price will always tell you where it's going to go. You don't have to look at indicators. As a default, I have the stochastics on my charts only to look for divergences. That is the only thing, because in the indicators, I consider the divergences to be one of the leading characteristics of an indicator. Let's have a look at the British pound. We've got this turmoil going on in the financial markets since the last 1 week with the major collapse of large firms. It has affected the currencies. Definitely it has. Your currencies have gone haywire. At such times, as traders, we should ideally keep out of the markets or stay out till the dust settles, as they say. But one point I want to make over here is even the fundamentals do drive the markets. Yes, they do in a longer term basis, but on a shorter term or on the technical basis, the levels of support and resistance are the levels decided by your technicals. They are not decided by your fundamentals. If the price starts moving in one particular direction, you can rest assured that there is a technical support or resistance where price will halt. Classic example is our British pound, sterling, GBP, USD on a monthly time frame. First and foremost, we had a strong down move for whatever reason, and we had price finding support. Firstly, it found support on a trend line. Now this is a trend line. We have followed two trend lines we have. This is one trend line. Price broke this trend line. It found support precisely at a trend line. Right? Dynamic levels of support and resistance. Now measured moves concept, before we get on to the fibs, measured moves concepts are very, very important. If you take up any chart and you take these moves, you will be surprised at the accuracy. The simple fact is, whenever I'm looking to analyze a particular chart, if I'm anticipating or I want to know where this move is going to terminate, is it going to go further down, is it going to retrace from here, I will have a look at the previous moves. This is my previous up move, this is my previous down move. The previous waves always gives you clues. Now, isn't it logical? Whenever you're using simple fib retracements, you will plot your fib retracements on the swing low to the swing high to give you possible levels of support. Simple, everybody uses fib retracements in the same way. In effect, what are you doing? You are using this previous wave to give you some clues about expected price action. But every price wave gives you clues. Now, I have plotted one measured move. We had, before our initial move started, we had a down move over here. If you look at this measured move, if I plot this over here, you can see that price stopped quite accurately at the same measured move distance. Now, these do hold a lot of importance. Measured moves, as I said, look back on any charts, try and plot simple measured moves. You will be surprised how price reacts around them. Now, at this particular stage, on the sterling pound, on the monthly time period, we have price stop at this. It doesn't necessarily mean that there's going to be a reversal. No, price may stop for some time, give you some pullbacks, whatever reason, whatever pullbacks. Just a moment. Some pullbacks, and then maybe it could continue the downtrend. As traders, we don't know, we don't care, we don't try to predict. We use our analytical tools to give us the best probabilities. As far as we are concerned right now, we have a support zone at a trend line. We have a support zone at the measured move, which indicates a double support zone. If I take horizontal levels of support and resistance, if I plot a horizontal line over here at this place, you can see that this also has acted as a pretty strong level of support turned resistance. You had price finding resistance over here, some support over here, support. Previously also you had price finding resistance. Price respects old levels of support and resistance. So you have three support zones over here, which gives you a probability that there is a very strong probability of the British pound bouncing up from here. How far will it go? Well, that depends on some other factors. Now let's use fibs. Let's come down to Fibonacci's. Now, if I plot my fibs from the swing high to this, swing low to the swing high. Let me remove this. You can see that price stopped exactly at the 50% fib. Very, very accurately. Now, I have a saying which I always say, tell me that fibs don't work. Why should price stop at fib? Now, whatever is the reason for this monthly, mind you, we are looking at the monthly chart. So we are looking at this strong downtrend, strong thrust on the British pound, which is close to almost 1,500 points. Whatever may be the reason for its decline, whether it's technical, whether it's fundamental, whatever it is, what is the reason for it to stop at this level? Technicals? Well, I would believe so. Maybe it could be fundamentals are affecting. Maybe, well, you could say that the US Fed has put together a package and the currencies are regaining their strength and everything looks fine. The equity markets are stabilizing down. Fine. Yes. Definitely one way of looking at it. But then again, why does price respect the confluence of this support zone so much? Why this particular place? Why not here? Why not here? Why do I have a confluence of a Fibonacci, a trend line, a measured move, and a Fibonacci, right? So technical levels. All right, looking at the British pound, we are anticipating a move towards the upside. Let me show you something else. Now, for those of you who have been with this sessions, the Monday Fibonacci sessions, we also use Fibonacci fans. I would like to use the Fibonacci fans. When does one use Fibonacci fans? You use Fibonacci fans when you come across a hidden divergence. Again, for those of you who are not familiar, you can download the PDF, or of course you can join my service where we look at these situations on everyday basis. We are looking at a bullish hidden divergence, which simply means that price is expected to go up from here. Very briefly, let me go over this hidden divergence concept. Your hidden divergence concept is when price has made a low and it has made a higher low. This is certainly a higher. And your stochastics, I use stochastics only. At this low, your stochastics have been at this particular stage. At the higher low, your stochastics have come down, stretched what they call beyond the means. It's not yet completely confirmed, but the way the stochastics have moved down, when price moves in a certain distance and your stochastics stretch beyond the means, they stretch a little too far. That means the stochastics are going to snap back. I call this the rubber band effect, which simply means that price will resume direction towards the upside. Again, if you want to know in details about about hidden divergences, you can download the PDFs. Now, a hidden divergence, the first confirmation of a hidden divergence comes with Fibonacci fans. If you plot your Fibonacci fans on the points of the hidden divergences, and price has not broken the last fan level, if it has found support at the fan level, the possibility of your hidden divergence completing is very high. We had price finding support at the Fibonacci fan levels, so we can expect price to resume direction to the upside. Now again, mind you, trading a hidden divergence is not just determining that this is a hidden divergence. There are rules and means based again on fibs. We still don't enter a long, but the indications are that price has found a pretty strong support zone over here. Now you may wonder what all this has to do with fibs, harmonics. We've looked at the fib retracements, we've looked at the fib fans. We have a very strong confluence of support. Fib fans, fib retracements, measured moves, trend line supports. Good enough? Okay, let's have a look at the GBP USD trying to go up. Now let me have a look at the sterling pound on the same monthly time frame, but forming a harmonic pattern. Again, tell me that the fibs don't work. If I look at this, if I plot my fibs over here, this is the bat pattern which we just went over on the PDF. My first retracement, let me label this. It is a bullish, it has formed, a bullish bat pattern, and one would expect price to resume or bounce up from this support. First retracement of B stopped at 50%, 38.2%. D, reversal level D, stopped at the 88.6 level. These are the characteristics of a bat pattern. Your first retracement stops at 50, first corrective wave at 50, second corrective wave at 88.6. Classical harmonic pattern. Now again, don't you think this is an example of taking out the stops? Price gives you some moves, expected price to go up, but it gives you one last thrust where it has found support. Now mind you, it doesn't necessarily mean that it is going to go up, but we start looking for longs. If you look at this, your BC, this is your BC wave, has also given you a fib projection of 261 quite accurately. So D is at a confluence of two support zones. Your D is at a confluence of a previous Fibonacci. It is at a confluence of some Fibonacci fans. It is at a confluence of a trend line. It is at a confluence of measured moves. How many more confirmations do you need for price to give you? It's like price is shouting you, it's kicking you in your face and telling you, look at me. Again, we just don't go longs. As traders, we look at if-then situations. Such strong parameters are definitely giving you longs, but let's base our trades on harmonics. right? On this particular harmonic, on the smaller term harmonic. Now, if price has reversed of D, what is the best place of taking it? First and foremost, what is your targets? Your targets would be your Fibonacci's. I would plot my Fibs from A to D. This is my XA, BC, Just a moment. You plot your Fib A to D. 127, 161 should be the targets. Now, if I look at the 127, 161, we are looking at considerably strong moves. We are looking at 2.21. We are at 1.84. So there's ample of time, there's ample of moves left on this one if it confirms, right? If it confirms. So what's the hurry of taking a trade? The policy, what I'm trying to tell you is, looking at such strong confluences, there may be a lot of traders who would want to jump into a trade. How does one trade a harmonic? Now, measured moves concept, again, coming down to the measured moves concept, in a harmonic pattern, this wave BC, this is your ABCD. Let me again label it once more. This wave BC is the minimum distance that price should travel to confirm the harmonic. So if you plot this over here, you have a level of resistance built up over here. If price manages to exceed this level, then the probability of your targets confirming are pretty strong. I'm going to take this measured move, plot it over here. If you go down to a weekly time frame, and if I have a look at this, I can see that price has broken or has gone beyond this. So the probability of price going higher is very strong. Again, should we just jump into a trade? Well, maybe it certainly is looking, but I need a technical trigger to get into a trade. I would rather go down to a smaller term time frame and I would look at this. Now, if I'm looking at a smaller term time frame, I'm looking at the 1 hour. Price for the shorter term looks a little overstretched. We are looking at a possibility of a bearish divergence. Again, these are based on Fibonacci's. You have price making high, higher high. Your stochastics are making high. So far, stochastics are pulling up. But if you look at your percentage D line, that is a red dotted line, it's not yet gone in the overbought level, which is telling me that this price has, this move has gone up with reducing momentum. And this is not the right time to enter a trade. Obviously, it's rather logical. If you are looking to enter a long trade, you would ideally want your stochastics or any oscillator to be in the oversold level, not overbought. An overbought level simply means that price could have a retracement. So we wait. We wait patiently because there is a lot of moves. Even though we have got very strong confluences, what I'm going to do is, ideally what one should do is plot a line over here at the measured move distance that we calculated. This move generally does become a level of resistance turns support. If I look at this, I may just cheat around a little bit, and if I just move this somewhat, I am determining possible levels of support resistance behind, right? Resistance, support, support, resistance. Price has respected this level. What I am going to look at is, I'm going to wait for some pullback. If it finds support at this level, it gives me a very, very strong confirmation, then I can afford to take a long. There is lots of time. I am not going to really look at it, and we will wait, because on shorter term time frames, we are looking at a loss of momentum. I will take a trade if I have a technical trigger. I am not going to jump into a trade only because I have strong confluences. Right, so these were the Fibonacci's. Very briefly, let me go over this again. We had a look at major Fib retracement supports. Again, anticipating price movements becomes very important. You had price waiting at 50% Fib of this swing low to the swing high. Now, if it stops at 50%, if I have a look at this harmonic pattern, didn't price stop at 50% over here? 38, sorry. This stopped at 38 and gave us a bat pattern can also give us a 50%. Isn't there a possibility of price giving you a harmonic pattern again and giving you a fresh low? Well, maybe. My point is, I am not really bothered about where price is going to go beyond this. I am more interested in this particular move right now, this move. At least I have a confirmation that this is the minimum distance that price will travel to, maybe even further. And how do I get that indication? It's by fibs. We looked at a fib retracement major support. We looked at a hidden divergence where your Fibonacci fans gave you support. We looked at trend lines. We looked at measured move concepts. And we looked at a harmonic pattern on a smaller term time frame, maybe on a weekly time frame. But again, price respects fib levels very, very accurately. This is one thing which I wanted to go over. I think that brings us to the end of the session. Right now, I have some question answers. We will continue with the recording. Any question answers? I'm ready to answer them. We can have a look at some other situations. I could have a look at some situations on the previous Gartleys or the previous harmonic patterns which have formed, but I'm sure there are some question and answers if that is the case. Right, Maud? Things are fine. Member 1000, as I mentioned earlier, if you go to my website, you have the PDFs over here, which I have tried to. This is my website, fibforex123.com. Sorry, we've got about 5 PDFs over here on the fib ratios. I've tried to make them as simple as possible. It's not easy initially, but believe me, once you get used to it, you begin to see these patterns anywhere and everywhere. So you can download those PDFs, and of course, if you have any questions, feel free to get back to me. My email is here mentioned, my email, my Skype is there. Oh, Ashu, you will be surprised. Absolutely. Believe me, there's just one thing which you must learn to do if you want to really look at it. Anytime price makes a move, anytime, whether it's on a 5-minute, whether it's on a 15-minute, 1 hour, daily, monthly, whatever, anytime price gives you some move, an impulsive wave, just plot fibs. You'll be surprised at the number of times that price will retrace down or find support or resistance, as the case may be, on a fib level. They occur on a daily basis, on 5-minute time frames, on 15-minute time frames, on 1 hour, even on 1-minute time frames. You just need to get that eye to catch it. That requires practice. It's nothing else. Anything about trading, Ashu, anything is nothing but experience. You have to learn to look at the price action based on the price patterns, not on indicators. Try and concentrate on price action. You'll be surprised after some time you will begin to see these patterns which you've never noticed. They do occur very, very often. I'll do that, Mike. In the next session of the Fibonacci's, there was a couple of requests on the fans and the divergences. Again, what we will do is next Monday, when we have the Fibonacci sessions again, I'll concentrate more on the fans and the hidden divergences. It's no problem. We are using fibs. You must understand the concepts very well. Simon, a Wolfe wave is another very important or a very effective chart pattern. This is called, sorry, where did it go? It's called a Wolfe wave. It's named after one Mr. James Wolfe, I believe his name is James, I think. It's a 5-wave pattern, much like an Elliott wave, but it's got excellent success ratios and very easy. Okay, Ashu, thank you so much. As an example, let me show you a Wolfe wave, which in our room we managed to catch on the Australian dollar on a weekly time basis. I wonder if I still have it. I do. There you go. This is a Wolfe wave. Oh, I'm sorry. Who mentioned it? Simon. Simon, a Wolfe wave is a 5-wave pattern. This is a Wolfe wave. We had caught this move, believe me, at 0.9500 round. I still remember this. Let's say from here. The characteristic of a Wolfe wave, once it is formed, it's a 5-wave pattern. 1, 2, you can see 1, 2, 3, 4, 5. Once it is formed, the target of the Wolfe wave is your line 1, 4. And price has got a 90% chance of coming down to meet that target. We have got this move, believe me, on the weekly time frame from 9500 to somewhere at 8300 round it was. We're talking about 1200 points, and only because the confidence that this Wolfe wave has got a very high probability of working. In between over here, price had given us some retracements, and we were not sure whether prices fundamentals were at play. Will the Aussie recover? Your commodities were beginning to recover, but we hung on to it for the simple reason that price will meet its objectives. So this is a Wolfe wave. Again, my point is try and concentrate, look at chart patterns, because it is the chart patterns which form due to the human emotions. What makes price move, Simon? It's you and me and the other traders in the market which is making the price move. It is not the physical valuation or the devaluation or the dollar or the pound or anything. It's you and me who decide where it's going to go. You think it's going to go up, you want to buy it, somebody who will sell it to you. Out of the both of you, one person is correct, right? Trading is a zero-sum business. If you try and look at the markets based on the psychology of the humans, looking at what the other trader is thinking and why is he looking at it that way, it will solve a lot of your problem. Yes, Simon, I do have a PDF on Wolfe waves, but that is specifically for our subscribers. I could give you some references. If you go to Investopedia, you'll find information about Wolfe waves. But what I have done is I have modified it. If not modified it, I've got a very simple 3-step approach to a Wolfe wave. Identify point situation 1, 2, and 3. If you have these 3 setups, it is a Wolfe wave or it is not. If you go to this website, investopedia.com, you will find, and you go for Wolfe wave, you'll find information on Wolfe waves over there. Or very frankly, I think the site of the Wolfe wave is wolfewave.com of Mr. Wolfe wave. You can have a look at that. Of course, if you want the way I trade it, you'll have to come to my website. Ashok, this one is not related to an Elliott wave. I said it's like an Elliott wave on a 5-wave pattern. A harmonic is a 5-wave pattern. An Elliott wave is a 5-wave pattern. A Wolfe wave is a 5-wave pattern. All 5-wave patterns have got this particular characteristic of taking out the stops. Even with your Elliott waves, it is the emotions of you are getting trapped into something, trapping other traders. Similarly, on a harmonic, how I explained, on a Wolfe wave, very briefly, if I may say so, very briefly, your 1, 2, 3 is usually a divergence, a bearish divergence. If you're looking at a bearish Wolfe wave, you would expect price to go down. If this divergence fails, then again price gives you one last thrust up, which again takes out the stops hidden or placed around 3. And then price resumes the direction of the trend. Now these are the characteristics of 5-wave patterns. Right? It's only with the intention of taking out the stops or taking out the amateur traders, the novice traders who are not really aware of the price movements. Right, folks, so if there's nothing else, I'll probably see you again next Monday. Next Monday for our Fibonacci's, we'll specifically go over Fibonacci fans and hidden divergences. They are related. Hidden divergences and Fib fans are hand in glove. One more drama. That's an interesting take. Still make a profit. One selling USD based on fundamentals, others buying to hedges currency positions. Rama, if you look at it this way, when you're talking about this kind of hedging currency positions, it is the genuine person or the banks who would hedge, or you have somebody dealing in foreign exchange who's got payments and revenues coming and going in foreign exchange. He is not into it for speculation. He is into it for the genuine purpose of trading. Now, he is not exactly, I wouldn't call it making a profit. Yes, he is hedging his position because he's safeguarding his own interests. When I'm talking about a zero-sum game, I'm talking purely about the speculators. Forex is technically based, right? I consider, see, right, thank you, Kananas, and thank you, Ashu. Let's have just one very interesting topic, because Rama has brought up a very, very interesting point over here. They say that Forex is a highly liquid market. Absolutely it is. But there are two facts which most of the traders don't really realize. One is that Forex tends to trend only 30% of the time. If you look at the historical data, you'll see that 70% of the time it does spend in a range. And then once it sort of moves out of the range, it explodes out of the range, giving you breakouts, and then it trends. It definitely trends. That is one thing a trader must be aware of. So you cannot just get into a trade anytime. You have to use certain strategies which will give you breakout, which will give you the expected price movements. That is one. Second point is Forex. The Forex is only one market which is more, or which moves more on technicals. For the simple reason, it does not rely too much on fundamentals. Longer term time frames, if you're looking at your weekly time frames, monthly time frames, you have the institutions who are trading it. Fundamentals do affect it. Now, again, don't get me wrong. I have never said that the fundamentals do not play an important role. But let's put it in perspective. In the equities market, in shares, in stocks, it is your fundamentals which come first. It is your price earning ratio of a stock. It is the dividends announced by the companies. It is government policies which will affect the stock. And you might get a correct entry into a trade looking at your technicals. Over there, your technical analysis takes a second seat. It's important nevertheless, but it takes a second seat. Now in Forex, your technical analysis comes primarily first. And I believe, now my take on it, of course, everybody is entitled to his opinion. I'm a hardcore technical analyst. I believe that the fundamentals are only an excuse for price to fulfill technical patterns. And I could prove it to you again and again and again. The British pound that we looked at is a classical example. Whatever was the reason for the drop in the British pound, it finally found support at a technical level. And what is the reason behind this? Because 90% of Forex trading is done for speculative purposes. 90%, believe me, and this is not what I am saying. It is a Bank of International Settlements who takes out a survey every 3 years or 4 years to determine the volumes. It is only 10% which is done for genuine purposes of hedging. Institutes, banks, people involved in foreign exchange revenues coming and going. So if there's 90% is technicals, speculative, isn't it obvious that it would be the technicals? No, Rama, I don't think it's a valid. In a way, it's correct, but let me sort of correct it a little. I believe your fundamentals fulfill technical patterns on a longer term basis, if I may say that. I would believe more in that statement. Any technical move. You had the situation when the housing market bubble broke, when initially you had the carry trades dropping like a stone. I could go to the GBP JPY on a weekly time frame when the carry trades really took a toss. The subprime mortgages hit the market sometime in the month of January, if I'm not mistaken. I still remember that, in the month of Jan. I could show you a head and shoulders pattern which got fulfilled on the pound yen because of the subprime mortgages. Now, you could look at it the other way around. You could say it's only one possible trade, one thing which had confirmed. But what I believe is once the fundamentals start moving the currencies, as a trader, you must look at technical levels to determine your next level of support resistance. That is what I'm saying. So if I'm not sounding too confused, I mean, this is what my take is. USD CHF daily. All right, USD CHF daily, I already had a technical. This is one which I had put up on my blog. We completed a harmonic, bullish harmonic for quite some time back. So you have a bearish Cartley. Okay, FX Visions. Let me remove the fibs. If you're talking about a bearish Cartley, are you talking about these fibs? So are you talking about this possible retracement, FX Vision? Okay, I think we have crossed our time. Interesting discussions. We will discuss this again next time we meet. It's been an excellent presentation. You all have been an excellent audience. I like when people really ask questions. Everybody benefits from it. So, all right, Simon, you are more than welcome. Yes, Rama, that would be a correct statement, that if your fundamentals and technicals are aligned, it certainly, I always call it, it puts the wind in your sails, right? Do that, FX Vision. In the meantime, I'll just hand over the room. I'm here in the room for some time. FX Visions, give me the points. I'll have a look at it. Thank you so much, everybody. It was a pleasure being over here, and I'll see you next week. Have a good week, good trading week, happy pipping, and nice weekend.